Welcome back to the deep dive. So our mission today is to really cut through all the noise and figure out what the central bank is actually signaling about your financial venture.
Yeah.
We're going deep on the Federal Reserve's controversial final rate decision of 2025.
And it was a big one, a quarter-point rate cut.
A huge one. And this move was made under, immense pressure, with deep divisions inside the committee, and critically, they were operating in a massive information blackout.
That's the perfect way to frame it. We've synthesized the official Fed statement, Chair Powell's press conference, and some of the key economic projections from outside experts.
And the goal here is to understand this really complex choice the Fed just made.
Exactly. They have this dual mandate, stable prices and maximum employment, and right now those two goals are just pulling them in completely opposite directions.
So they were forced to choose.
They were. Choose between recession fears on one side and, these persistent inflation risks on the other, all while, as the sources noted, flying blind. They just didn't have the data.
Okay, let's jump straight to the action then. What's the headline fact?
The headline is that the FOMC, the Federal Open Market Committee, they cut the federal funds rate by 25 basis points.
And that sets the new target range at
3.50 to 3.75%. This is the third cut since September.
But this was not a happy consensus move, was it?
Oh, far from it. This was one of the most contentious decisions we've seen in years.
Yeah.
It passed on a 9-3 vote.
9-3. That's the highest level of dissension since 2019, right?
It is, and that signals a really significant policy disagreement happening right inside the room.
So can you break down that 9-3 split for us? What were the three dissenters arguing for?
Well, you had two different camps, really. First, you had two members who voted for no change at all.
The Hawks.
The classic Hawks, yeah. They're worried that inflation, which is still near 3%, is just too high. And they're arguing that cutting now sends the wrong signal.
That it could undo all the progress they've made.
Exactly. Then on the other side, you had one member, Stephen Marin, who wanted a much more aggressive 50 basis point cut.
The dovish dissent.
Right. He believes the labor market is falling apart so fast that the Fed is, already behind the curve, and they need to act now to stop a deep recession.
Wow. So 9 members agree on a small cut, but the 3 who disagree are at complete opposite ends of the spectrum.
It's a huge fracture.
That signals just incredible uncertainty. And that uncertainty was made worse by what they didn't know.
Absolutely. The decision was made in what you can only call a data void.
Because of the government shutdown?
The 6-week government shutdown meant the Fed was meeting without any official, reliable government data on inflation or jobs since September. No fresh CPI, no PCE, no payroll numbers.
So they were basically steering the entire U.S. economy using what? Incomplete intelligence, private sector report?
Precisely. Fragmented reports, like that one worrying estimate showing a loss of over 30,000 jobs.
Chair Powell himself had that great analogy for it, right?
He did. He used the fog analogy in his press conference. He said the lack of data meant they had to proceed with caution.
And he asked, what do you do if you're driving in the fog?
You slow down.
Yeah.
It just perfectly captured the moment. The decision to cut was forced by these two conflicting stories that they couldn't fully verify.
Okay, let's talk about the job market worry first. Why was there this sense of panic that would justify a cut when inflation is still so high?
It really came down to the speed of the slowdown. Unemployment is only at 4.4%, up from 4.0% in January. But it's the speed of that rise that's setting off alarms.
You mean the SAM rule?
Exactly.
The SAM rule.
Okay, let's unpack that. It sounds super technical, but what is it actually measuring?
It's named after the economist Claudius Sam, and it's actually a brilliant, simple indicator. It doesn't look at the absolute unemployment rate.
It looks at the change.
Right. It looks at the 3-month moving average of the unemployment rate compared to its low point over the last 12 months. If that average rises by 0.5 percentage point or more, it has always, without fail, meant a recession is starting.
Without fail. It measures the velocity of the distress. And the sources show that as of December, we were getting dangerously close to tripping that rule.
So that's the urgency. That's what pushed them to cut. They had to ensure against a hard landing now.
Before the SAM rule basically confirms they're already in one.
But the downside risk is just massive. You cut rates to save jobs, but you could make the other half of your mandate price stability impossible.
And that's the inflation worry. It's still highly elevated. The Fed's preferred measure, the PCE, is stuck at 2.8%.
Which is nearly a full point above their 2% target.
So cutting rates now is like pouring a little bit of fuel on that fire. The hawks who dissented, they worry this cut makes it nearly impossible to get back to 2% without having to hike rates again later.
Okay, so they chose the labor market risk for now, But what about the future? That brings us to their 2026 outlook and that notorious dot plot.
The dot plot is critical. It tells us where the consensus is headed.
And for anyone who doesn't follow this stuff, it's just a chart, right? Where each member anonymously puts a dot where they think rates will be in the future.
That's it. It's their collective forecast.
Yeah.
And the market was really hoping for a strong signal of more cuts coming.
Yeah, they were pricing in maybe 4 or 5 cuts next year, pushing rates way down below 3%.
And the market was severely disappointed.
Right.
Despite cutting now, the median dot for the end of 2026 stayed pretty firm at 3.25 to 3.5%.
Which, if you translate that into action, implies, what, only one more cut next year?
Only one more 25 basis point cut. That's it.
That is a huge mismatch. It's like they're giving with one hand and taking away with the other.
And that's why analysts are calling this a hawkish cut.
A hawkish cut.
Yeah, they cut now to calm the job market fears, but then they signal extreme patience for 2026. It's a message to investors that a quick return to cheap money is not happening.
And we can't really talk about 2026 without mentioning the political shadow that's looming over the Fed, can we?
It's impossible to ignore. Chair Powell's term is up in May 2026.
And the sources note that President Trump has been very vocal, demanding lower rates, and has reportedly zeroed in on Kevin Hassett as a potential replacement.
Who is a proponent of much more aggressive easing. So Powell is walking this absolute tightrope. He needs to maintain the appearance of independence.
Right.
And the sources suggest this hawkish cut was a strategic choice. Give the immediate relief with the cut, but use the dot plot to reassert the Fed's independence and its inflation-fighting credentials.
It's a very tricky balancing act. And the market's initial reaction was what? Stocks up?
Stocks surged on the cut, yeah. The U.S. dollar dipped. But that optimism is running headlong into a pretty uncomfortable reality.
Which is the consensus forecast for the economy in 2026.
Which is, in a nutshell, stagflation light.
Stagflation light. Okay, let's spend some time on this because it implies the worst of both worlds. What does that actually mean?
It means persistent discomfort, not, a total collapse. The forecast has two things happening at once. First, the stag part. GDP growth is expected to be slow, below trend, somewhere between 1.8 and 2.3%.
Okay, so slow growth.
And then the inflation light part. Inflation is forecast to stay uncomfortably high. It'll be stubbornly above 3% for most of the year, still well above that 2% target.
Slow growth and sticky prices. That puts the Fed in a corner, doesn't it?
It really does. If they cut to boost growth, inflation might accelerate. If they hike to fight inflation, they could tank the economy. They're trapped.
So why is inflation so sticky? I mean, why won't prices come down even with these rate cuts?
Well, it's multi-layered, but it's driven heavily by services and some global supply issues.
Services inflation, I know that's tied to wages. If the job market is slowing, shouldn't wages be cooling off more?
They are, but slowly. Services are labor-reliant, and wage growth is still stickier than the Fed would like. But the biggest factor economists are pointing to is housing costs.
You mean owner's equivalent rent, OER?
Exactly. OER.
And that's one of those Fed terms that confuses people. It's a huge part of the inflation number, but can you just simplify what it is and why it lags so much?
Sure. Think of it as what a homeowner would rent their own house for. The Bureau of Labor Statistics asks them. But the key is that lag. They collect this data on a rotating 6-month schedule.
So it takes a long time for today's market conditions to show up in the official number.
A really long time. So the increase in housing values from, say, 18 months ago is only now filtering into the official inflation calculation.
So even if rents are stabilizing in real time, the Fed's official metric is still catching up to the past. That's a powerful force keeping inflation high through 2026.
It absolutely locks it in at a high level. And then you have the goods sector, the effect of the new tariffs.
The taxes on imported goods.
Right. They haven't fully passed through to the consumer yet, and experts predict those effects will actually peak in the second quarter of 2026.
Which brings us back to that labor market paradox. Slow growth, but a structurally tight job market. Unemployment is only expected to plateau around 4.5%. Why aren't we seeing massive layoffs?
Because this is a structural shift. It's about demographics, not just demand.
Okay.
The labor market is tight because of massive supply shocks. First, you've got peak baby boomer retirements. That's taken nearly 3 million experienced workers out of the labor force since 2024.
And second,
changes in immigration policy have slowed the inflow of non-citizen workers, so there just aren't enough bodies to fill the seats.
so even if the economy slows, there's a structural labor shortage that keeps wages, and therefore services inflation, from falling too quickly.
Exactly. The unemployment rate just has a lower ceiling than it used to.
And just briefly, what about AI? Is it having an impact yet?
Well, yes, but not in the way you might think.
Yeah.
We see massive investment in data centers, and that's boosting GDP growth. But economists don't see measurable productivity gains yet.
So it's not replacing workers in large numbers in 2026.
Not yet. It's fueling infrastructure growth, but that productivity dividend hasn't really paid out.
Now let's talk about how this all feels to you, the listener, because the national picture just completely fragments here. The sources talk about a K-shaped divergence.
Yes, the divergence is stark, and it's based on wealth and, crucially, the source of your income.
Let's start with the top of the K, the upward arm.
That's the top tier, the wealthiest 10% of households. They're doing absolutely fine. They're driving consumption, especially in luxury goods and services.
And what's fueling their spending if wage growth is slowing down for everyone?
It's their non-labor income streams, things that have seen just phenomenal growth.
Yeah.
Dividends, interest, and rental income.
Asset-based income.
Exactly. Plus, they've benefited from things like the increased SALT cap deduction. Their wealth is growing, and that's pulling the top of the K upwards.
Okay, now contrast that with the downward sloping leg of the K.
That's the middle, say the 20th to 80th percentiles. And they're feeling the full pinch of stagflation-like. They're getting hit by high prices for essentials and high borrowing costs.
And we're seeing that in the data, right? Delinquencies.
Rising credit card and auto loan delinquencies, yes.
Yeah.
They're still spending, but the sources are clear. They're only being held together by the tight labor market keeping them employed.
If their job security goes, that leg of the economy could collapse.
It could. It's very fragile.
So let's translate this Fed cut directly to the listener. How much does this third cut actually save someone?
Well, the savings are real, but they're very unequal. The biggest impact is in mortgages and home equity lines of credit.
Okay.
Someone taking out a $500,000 mortgage today is paying roughly $584 less per month than at the peak rates in late 2023.
That's significant.
It is. A $50,000 HELOC is about $100 less per month. If you're buying a home or tapping equity, the relief is tangible.
But what if I'm on the other leg of the K, struggling with credit card debt?
Minimal impact, unfortunately. The average credit card APR is still sky high, around 19.83%. The 3 rate cuts so far have saved the average borrower maybe $6 or $7 a month.
So waiting for the Fed to save you from credit card debt is not a strategy.
Not a viable one, no.
And what if I'm just trying to protect my cash, my savings?
You have to be active. High-yield savings accounts, HYSAs, they're already drifting down from their 5+% peaks. They're around 4.2% now.
Which is still way better than a big bank.
Oh, absolutely. The real trap is leaving your cash in a major bank where you're getting like 0.01% APY. A $10,000 balance there earns about $1 a year. You're just guaranteed to lose money to inflation.
Which brings us to the practical takeaways. If we're in this stagflation-like K-shaped world, what can you actually do? We have to be our own Federal Reserve.
That's a great way to put it. The experts gave 5 key pieces of advice. First, they said, track your personal CPI.
Your own personal inflation rate.
Exactly. Tune out the macro noise, track your own spending to see where costs are actually rising for you, and then adjust your budget strategically.
Smart. What was the second piece of advice?
Debt priority is paramount. Since the Fed isn't helping much with consumer debt, you have to focus all your resources on paying down high-cost debt first, especially credit cards.
I liked that quote from one of the sources.
Yeah, no investment consistently beats 25% interest working against you. It's a guaranteed high-return move.
And for cash.
Strategic cash parking. You got to move it from those big banks paying 0 to an HYSA or a short-term CD. You need to at least keep pace with inflation.
What about big loans? A mortgage, a car loan? Should people wait for more cuts in 2026?
The advice was refinance opportunistically. Don't hold out for the absolute lowest rate that might never come. If you need a loan, lock in the savings now. You can always refinance again later if rates drop more.
Right. As one source said, you don't know when that music is going to stop. It just stops.
Exactly. And finally, for investments. Stay diversified and stick to the plan. Use market volatility to rebalance, but the fundamentals don't change. Emergency fund, max out retirement accounts.
So let's just recap this incredibly complex balancing act. The Fed cuts rates to hedge against a job market slowdown.
Right, driven by that Sam rule getting close.
But they simultaneously signal a much slower pace for 2026 than the market wants, with maybe only one more cut.
And they're doing all this while flying blind on the data.
And navigating this structurally tight labor market, meeting sticky inflation from housing and tariffs, all while the consumer is just splitting in two.
The whole macro picture is less about a big collapse and more about, this persistent, slow-burning economic discomfort. That structural tightness in the labor market is really the key tension.
Which brings us to a final thought for you to mull over. The Fed's biggest tool is the interest rate, right? It's designed to influence spending.
That's the theory.
But our sources show that the most influential money, the money driving consumption, that top arm of the K, is shifting away from wages and toward investment income. Dividends, interest, rent.
Wealth, not work.
Exactly. So in a world increasingly driven by that kind of income, how much power does a traditional quarter-point rate cut truly have over the people who are actually driving the consumption bus?
That is the profound question that will define the Fed's effectiveness for the next decade. Your strategy has to adapt to that.
That's the deep dive. Thank you for joining us. We'll see you next time.